Cryptocurrency is one of the most volatile asset classes in the world. Prices swing wildly from day to day. But is this volatility good or bad? And should you be investing your hard-earned cash into these digital coins? Hey there! Welcome to our channel where we demystify investing. The price of Bitcoin has been known to double in a single day, drop 30% in a week, and even soar 80% in just 2 months. This wild price action means that cryptocurrency can make investors a lot of money very quickly. But it's also possible to lose a lot of money fast. So what exactly is going on? First off, let's get a clear definition of volatility. In simple terms, volatility measures how much the price of an asset fluctuates over time. High volatility means prices move around a lot. Low volatility means prices don't move around much. When we say that cryptocurrencies are volatile, we mean that their prices change rapidly and dramatically. Just think about it. Between 2017 and 2018, Bitcoin's price went from $20,000 down to $6,000, a drop of more than 70%. To put this into perspective, if you had invested $10,000 into Bitcoin at the peak, you would only have $3,000 left after the drop. That's a massive loss, especially when you consider that stocks typically only see drops like that once every few years. There are several reasons for crypto's wild price swings. For starters, the cryptocurrency market is relatively small compared to other financial markets. According to Statista, the entire crypto market cap is about $1.9 trillion as of January 2022. In comparison, the global stock market is valued at roughly $77 trillion. This means that crypto markets are much more sensitive to changes in investor sentiment, which could explain why prices fluctuate so much. After all, a positive headline about Bitcoin could boost the price by a few $100s, while a negative headline could send it crashing by thousands of dollars. Another reason for crypto's volatility is the hype surrounding it. Many people see cryptocurrencies as a once-in-a-lifetime investment opportunity, which causes prices to skyrocket. But because so many people view them as a get-rich-quick scheme, they also crash just as quickly. Think of it like a game of hot potato. When the music stops, the last person holding the potato is out of the game. And when there's no new hype around cryptocurrencies, the price tends to go down. But what about Bitcoin's recent surge to almost $50,000? Is this just another example of crypto volatility, or is something else going on? Well, actually, Bitcoin's rise in price is due to a combination of factors, including supply and demand, media attention, government regulation, and adoption by major companies. For instance, since the supply of Bitcoin is limited to 21 million coins, the price tends to go up when demand is higher and vice versa. Additionally, positive news stories about Bitcoin cause more people to invest in it, driving the price even higher. However, when regulations are imposed or major companies stop accepting Bitcoin as payment, the price usually goes down. It's also important to note that Bitcoin is not the only cryptocurrency that's been on a wild ride lately. Ethereum, Cardano, Binance Coin, and Solana have all seen their prices skyrocket in recent months. This is likely due to the growing popularity of decentralized finance, or DeFi, which allows users to earn interest on their coins, borrow money, and trade in a variety of other ways. In fact, the total value locked in DeFi has grown exponentially since early 2020. It was only $1 billion in June of that year, but reached nearly $90 billion in December 2021. This growth shows that investors are increasingly interested in cryptocurrencies and willing to take risks with their money. When trying to predict future price movements, it's helpful to look at historical data. Let's take a look at Bitcoin's price history to see if we can spot any patterns. We'll use a logarithmic scale to make it easier to see the big picture. Now you can see that Bitcoin's price has increased exponentially over time. Of course, this is unsurprising since the supply of Bitcoin is limited and more people are using it every day. But if we zoom in, we can see some interesting price patterns. Notice that Bitcoin's price often doubles after a steep drop. For example, between December 2017 and December 2020, Bitcoin lost more than 80% of its value. But since then, it's increased by nearly 200%. There are many other examples of this pattern throughout Bitcoin's history. So why does Bitcoin's price follow this pattern? Well, there are a few theories. For one, Bitcoin's price often goes down when the overall market is bearish, meaning that investors are generally pessimistic about the future. But when the market turns bullish, meaning that investors are optimistic about the future, the price of Bitcoin tends to shoot up. This explains why Bitcoin's price doubled after such steep drops in 2017 and 2020. Additionally, Bitcoin's price is often influenced by media attention. When the price is low, negative headlines cause prices to drop even further. But when the price is high, positive headlines cause prices to soar. This can create a self-fulfilling prophecy. As the price of Bitcoin rises, more people become interested in it, which causes even more positive headlines and therefore even higher prices. Looking ahead, it's impossible to say whether Bitcoin's price will continue to rise or fall. No one can predict the future with certainty, especially when it comes to something as volatile as cryptocurrency. However, it's worth noting that some experts believe that Bitcoin is in a long-term uptrend. They argue that the price will continue to rise over time due to increasing demand and limited supply. Others believe that Bitcoin is in a long-term downtrend and that the price will eventually return to zero. Of course, these are just predictions, and no one knows what the future holds. In addition to the inherent volatility of cryptocurrencies, there are also risks associated with where you choose to buy them. For example, centralized exchanges like Coinbase and Binance are vulnerable to hacking. In 2014, for instance, hackers stole $850,000 worth of Bitcoin from the Tokyo-based exchange, Mt. Gox. And in 2016, hackers stole $60 million worth of cryptocurrency from the Hong Kong-based exchange, Bitfinex. These hacks show that it's important to do your research and only buy cryptocurrencies from reputable exchanges. It's also a good idea to use a hardware wallet like a Ledger Nano S or a Trezor Model T to store your coins offline. Doing these things can help keep your crypto safe and secure. If you're still on the fence about whether to invest in cryptocurrencies, you might want to consider the fact that prices have bottomed out several times since 2011. For example, in January of that year, worst Bitcoin was worth about 8 cents. Then in November 2012, one Bitcoin was worth about 11 cents. And in January 2015, one Bitcoin was worth about $200. These are just a few examples of times when Bitcoin's price bottomed out. The point is that investing in cryptocurrency can be risky, but it can also be rewarding. If you're willing to do your research and take on some risk, then maybe it's right for you. But if you're not comfortable with the potential downsides, then maybe you should stick with more traditional investments like stocks and bonds. Before we wrap up, let's answer the question we posed at the beginning of this video. Is crypto volatility good or bad? Well, it all depends on your perspective. If you're a trader who likes to buy low and sell high, then crypto volatility can be great. You can make a lot of money very quickly if you're good at timing the market. However, if you're a long-term investor who just wants to buy and hold, then crypto volatility can be bad. It can be frustrating to watch your investments drop in value, even if you know that they'll probably go back up. Ultimately, it's up to you to decide what level of risk you're comfortable with. But hopefully this video has given you some insight into the world of cryptocurrency and how it works.